Hello, traders. How are we all doing today? I hope everybody is well. Hello to Jacob, Vincent, Ratish. Hello to you guys. Welcome to the stream. Hope you're all doing well. I want to know in the chat who's traded this week. I, for one, have not. So I've been sitting on the fence this week. It's a big data week, obviously. And I've sat on the fence for a large majority of it. And we've seen some turnarounds coming into the US session, which I find quite interesting. So we'll obviously talk a little bit about that in a moment. And what's been going on in the markets. A little bit of a divergence play potentially coming here on cable. So something to look out for. But we'll see. I'm doing well, fine. Thank you, Ratish. How are you? Hi, CG. Yeah, let me know. Let me know if you've been trading. I don't know if I can I do polls on here? I have to create some other platform before doing a poll, so that won't be happening. Just let me know. I want to know who's traded this week. Like I said, I've sat on the fence for a lot of this week. Well, I haven't took a trade this week. I've been waiting to see how the market takes the information that we've been seeing at the moment. Obviously, there's been huge changes in the market. Arguably, the biggest data out was the Federal Reserve. This week, let me just go to this week. I'm just going to change this to high impact. And where are we? On the 19th. Here we go. So I was short dollar yen this morning, closed with a small profit. Nice. Yeah, dollar yen's an interesting market to have a little look at. I think from a currency strength point of view, I want to be a buyer of the Japanese yen, but the commitment of trade reports are saying something completely different. So I want to follow the commitment of trade reports as much as possible, really, because obviously they are the big players in the game. My currency strength meter is a technical based indicator, so you want to be looking at that a little bit more. But we'll go take a look at those in a minute. Obviously, they would have had the latest data out of that this week, so that will be coming out tomorrow. So we'll see if that has changed anyway, shape or form. But yeah, let's talk about the Fed funds rate decision. So we had a 50 basis points cut. We were expecting a 25 basis points cut. We didn't. We had a 50 basis points cut, or a 0.5% change. Very interesting, this cut, not just because it was almost an aggressive cut. It was a Fed that was very much talking about the labour market conditions, talking about core PCE as well, which is coming out next week as well. I believe the latest update to that next Friday, core PCE price index month on month. Yeah, basically talking about how there's been some pressures in the labour market. It's actually very contradictory of what he was saying, because one moment he was saying that they cut because the labour market was very fragile and they'd seen quite a significant change there, and then in the next breath he's saying that he wants to keep the labour market strong, and it is strong and it's growing at a good pace, and things like that. So very contradictory. Now, obviously, the FOMC chairman isn't going to come out and say, we messed up, we should have cut 25 basis points in July. They're never going to do that, right? But it was an interesting statement to see, and kind of what they are focusing on. Obviously, the labour market is something that has been under pressure recently. I think on average this year, it got revised down to 116,000 jobs created on average per month. So that was has been sort of downgraded a little bit from what it was. If we check out the revised figures annually, I think it was down 1.2 million, I think it was, in the workforce. They still kind of reiterated that they're not seeing sort of job losses from companies, which, is strange when the unemployment rate's gone up, but we'll have to just take their word for it so far. But obviously there are other indicators out there that can help us kind of, see what the market is thinking in terms of, are the Fed going to cut again? How aggressive are they going to cut the Fed? Going to cut, one of those being the US bond yields. You've got the 30-year bond yields, the 10-year bond yields, and the 2-year bond yields. 2-year bond yields are more reactive to the Fed funds rate. If I just actually close this off, and what I'll do is I'll get the Fed funds rate and just add that to the screen. Okay, they are the most reactive. Let me just turn this to a weekly chart and a line chart as well. And let me just pop this to the right-hand side. Let me just index those back to regular. So these are the most reactive to what's going on in the bond yields. So basically because they're more short-term, right? So they need to be more reactive to what's going on in the market. And you can see typically when we start to see the bond yields or the US 2-year bond yields fall, then, we do typically see interest rates go with it. At the moment, we're now down to 4.5%. This hasn't updated yet, so bear with me there. It should drop like that. But essentially, you can see down here, US 2-year bond yields start to rise. They start hiking interest rates. US 2-year bond yields fall. They start cutting interest rates, right? You can see these yellow markers on the screen as well. Basically, what these are is the crossover points from an average point of view. So what I was looking for was sort of signals of when we are more likely to cut from the Fed. And if we have a little look at the 100 moving average, you can see that when we typically start getting that crossover, very soon after that, we start seeing the interest rates start to change, right? So we were holding through this period here. We crossed over the 100 moving average. We then started to see the declines over here as well. You can see we broke out of the 100 moving average there. It took a long while for this one to come back in at that point. If I just prop that onto step line, no, not this one. Get that on a line. Okay, you can see obviously we held those rates down there for a good while before seeing that sort of continuation. So yeah, at the moment the market is definitely pricing in more cuts. Especially if we do see bond yields, US 2-year bond yields continue to fall, then there's a good chance that we're going to see the Federal Reserve continue to cut interest rates. And that's what they have said. We're expecting at least another 50 basis points by the end of the year. So that's just something to take into consideration. Something else that's quite interesting is the 10-year versus the 2-year bonds. If you actually put them next to each other or versus each other, you can actually see that they have now started to cross over. They're now starting to push back to the upside as well. Let me just delete the Fed funds rate off of here. And what this is basically telling us is that the market is favoring 10-year yields over 2-year yields. So they're starting to favor more midterm, long-term yields over the short-term yields. And basically that could mean that the market is uncertain and they're trying to find value by holding for longer periods of time. They might get a worse return on those bonds, but they can hold them for much longer and through economic uncertainty, right? And that's what we're seeing at the moment. This market is starting to rise. Just to kind of show you that here, when we look at 2020, when we had the COVID crash, you can see the US 10-year yields were trading higher than the US 2-year yields. If we go back to 2008 here as well, you can see that we have the 10-year yields trading higher than the 2-year yields. And then back in 2001, when we had the crash relating to the September 11th attacks and whatnot, you can see we had those there. Very much back in the 90s as well, when we had another crash in the market favored those 10 years over 2 years, right? So that's what we're looking at here right now. Market is starting to break up, starting to reflect the similar sort of pattern that we've been familiar with in the past. Just because they are rising though doesn't mean that there is going to be a recession, right? You can see that they rose here periodically, and we didn't get necessarily a recession in 2013, but we did have a sort of small crash in like 2015. But yeah, other than that, that's what I'm kind of looking at the moment. That's what I'm focusing on. And if you want to be focused on sort of interest rates in the market, you need to be looking at your bonds and the bond yields as well. And I like to look at those on a regular basis. But yeah, let's have a little look at how the market's shaping up from equity point of view. If we look here over on the right-hand side, equities are flying at the moment. If we go take a look at the US 500, you can see that we are up 1.55% on the day. If I look at the daily chart here, see the NASDAQ is up 2% on the day. And we can see that the Dow Jones is up up 1.05%. You can also see the Russell as well performing very well. So they're sort of mid to low cap stocks. That market doing very, very well off of the rate cuts as well, which I do believe would be a strong market to go and have a little look at. The Russell. FTSE just going sideways at the moment. Bank of England just held interest rates, so we're not really in that sort of easing cycle. Typically the FTSE in an easing cycle does perform pretty well, but we have not been in an easing cycle for a while now. Back in 2020 was obviously when we started to see that easing cycle, and the market performed very, very well. But as we kind of hold interest rates in the UK, the market can tend to just go a little bit sideways there. DAX is starting to perform a little bit better, starting to see an increase in the DAX. This market starting to breach into sort of 19,000 and above now, which is quite interesting to see. So seeing some decent moves over in Germany. That's again probably positivity from those rate cuts that we saw over there as well. Nikkei up 2.9% as well as the Hong Kong 50, which is something that's interesting to me at the moment, because a lot of Chinese data out at the moment, not particularly the best. So seeing this starting to move higher a little bit, might start to think that maybe that the stock market is undervalued here. We came into this really nice sort of support zone through there. Gold up 0.74% on the day, coming back off the highs. Actually, I was looking at this earlier, and I was looking to see whether price would come up into the sort of highs from the FOMC. We haven't quite come into those yet, and price is just holding here. So I'm waiting for price to kind of push a little bit higher here on gold, see if we can kind of come into that area there. I was trying to think of targets for gold. You know, if it is going to continue just to keep going, where could we go and target gold? So I was just playing around with some pivot points, and I was looking at weekly pivot points, and I can see there's a weekly pivot around about the $2,615 area. So if we do surpass highs again, that could be a good area to see some market stalling at that point. So I was just kind of looking at how we could use maybe higher time frame pivots. You can see that we reacted from the main pivot this week on Wednesday, yesterday, after the FOMC event, and the market kind of rallied up there. So yeah, quite an interesting move on gold at the moment. Obviously, we've been talking about upside in gold for a while because, the commitment to trader reports are still saying that gold is a decent long, in my opinion, because they're not selling too aggressively at the moment. Let's just have a quick look at gold. We're starting to see, obviously, on the commitment of trader reports that, we are starting to see those kind of long signals coming into play. But again, if I kind of look at what I'm expected to see, well, I'm expected to see shorts being at sort of all-time highs, or at least to close to extremes where we've seen significant reversals in the past. And look, that was the reversal we had where we had short contracts up at significant levels. Prices, so that was around $2,000. We're up another $600 from that point. I don't know what that is in terms of sort of percentage gain from that. This was the last time we had a very aggressive sell signal from the commitment of traders report, and sort of since then, how far have we gone? We've gone 35% higher from that level. From the lows here, we're up 144%. So gold's still on for a decent rally here. We haven't had that. Sorry, that was 2022. That was. I went back a little bit too far. Here was the last sell signal on the commitment of trader reports. Let's just take the high there. That's still quite similar. 25% move higher. So looking for something similar again. That's what I'm waiting for on gold. Before I start getting short on gold, that is exactly what I'm waiting for. I'm looking for those short positions to come to extreme levels. Not there yet. On the opposite side, we've got the large speculators, the traders within the market. They did reach a similar extreme, or came very close to a similar extreme that we saw at the same time. Again, still not quite there yet. So it's telling me that basically, from a commitment of traders' point of view, gold prices could still continue to trade higher in the short term. It's just about how and where you get into these types of positions, right? Always kind of try and look for areas of support resistance, areas of where volume would come into the market. So you can see here, this was obviously an area where we've accumulated and then prices rallied out of that area. So there'll be a lot of volume down towards this point. So for me, if I want to be a buyer of this market, this is an area I want to start buying from. So if price was to come back towards sort of 25, 27, we could see another little bit of a move higher here on gold. Sorry, I missed some messages. What's up with CAD today? I haven't actually looked at CAD. Let's have a quick look. So CAD is a little bit stronger than the US dollar at the moment. We're just in this weird zone at 136. We did quite like the idea of, seeing if price would break this area. That was if the dollar found strength, right? We haven't really moved anywhere on the US dollar, right? So 101 seems to be a significant sticking point. We try and break lower. We fail to break lower. Again, we've tried to make a move towards the lows today. Price has been supported. Looking at the stochastic here as well, quite interestingly enough, price has made a new low, but we're starting to see that sort of divergence there. So is it time to see a potential reversal on this US dollar? That's what I'm expecting. I'm expecting a dollar reversal situation. I think that the dollar is fairly cheap at the moment in comparison to where it has been, obviously. But I would have liked it down at these levels, this kind of $99 area. That would have been a strong area of support for me for sort of an opportunity to buy US dollars. But I'm just waiting at the moment. If I go to euro as well, you'll see a very similar setup. You know, the market has tried to break through these swing highs here and just continue to sort of fail. So yeah, just going to see how the sort of dollar starts to play out before we start really getting involved with markets. You know, one of these is dollar CAD. You know, if we can see that dollar CAD starts to range at this 136 handle, then it breaks to the downside, then yeah, maybe we can start shorting dollar CAD down, buying CAD across the board against other currencies. That hasn't quite had the same impact yet. What's quite interesting about the market, though, is the volatility index, right? So I expected volatility to have another little spike. And the reason being was because of the data that was coming out. I just expected the volatility to be a little bit crazy. And that hasn't happened, right? That hasn't happened. So if we're going to see a decline in volatility, then we should expect a risk-on rally. And if we expect a risk-on rally, what will that mean? Well, it means that you want to be buying risk currencies. That includes the Australian dollar, the New Zealand US dollar. You want to be selling haven assets. So you want to be dollar yen long, dollar Swiss long, essentially. And that's if we get this volatility risk or volatility lower, right? Volatility needs to drive a little bit lower for me to start really getting aggressively involved, because the picture in the dollar is not perfect at the moment, is it? There's a lot going on there at the moment. But yeah, we'll see what happens there. Obviously, the Chinese one's a little bit stronger as well. I think this is going to be a market that drives a lot lower. But let me know your thoughts. You know, I mean, we look at euro here. Let me just get rid of some of these drawings off here. And it is in a very interesting place, right? You know, this is a monthly chart. So that's a monthly moving average there. I think that's the 100 moving average. Is that right? Yep, that's the 100 moving average. And I think euro dollar would be very expensive up at 112s. But that's just me. Trying to see where we were around 2007. November, December. That was the 08 crash there. Yeah, interesting place at the moment. So we'll see. We'll see if we get any kind of move there. The only thing I'm looking at this from a technical analysis point of view is price has tried to go into resistance. It's failed, and it's now back at resistance. The lows are getting higher. Okay. That would be indicative of a breakout to the upside for me. But again, this is going to depend on how the market values the dollar going forward. If we're expecting strong cuts coming in the future, you know, we'll take a look at that bond market. But if we go and have a little look at the 10-year bond yields, for instance, and just pop that on a weekly chart there, and I'll just add the dollar index to compare that. And then we'll just add that to the right scale. You know, typically the 10-year and the US dollar have a good relationship, good correlation with each other. Let me just pop that on a line chart as well and get rid of the EMA for a second. You usually typically see that they have a really good relationship with each other. That also works with the inflation rate as well. If you type in US, and you can see here, you get a number of pieces of the tools that you can use. If you just go to the United States inflation rate year on year, And then I didn't want to do that. I wanted to compare it, didn't I? Sorry, let me go back to those bond yields. US 10-year bond yields. And then if you add, here we go. US see if I can find it. There's the M2, United States government bonds, 20-year bonds, 1 year. Is it economy? Here we go. Yeah. Here we go. Usually the inflation rate drags the bond yields, right? So if I just take off, which one's the dziecii now? That one. The purple line's the dziecii. Let's remove that. Usually, so you've got the purple line, which is the US inflation rate, right? And you've got the white line, which is the US 10-year bond yields, okay? Now, usually one will drag the other. So if you look at the inflation rate here and the inflation rate's coming down, so this is good as well if you want to be, again, investing into sort of different asset classes. If you see that the inflation rate is coming down, you can see that the bond yields follow that. You see a little bit of a spike in the inflation rate. Bond yields follow that, a decline again, decline, blah, blah, blah. And then recently, obviously, we had the aggressive spike in inflation. US 10-year bond yields started to rally after. So, okay, it's after that. So you can see after that, the US bond yield starts moving. We've had a very extreme breakdown in the US inflation, right? So you can see that we've come from these significant highs here. We're actually just put that on a regular scale. You can see that we've actually come up from the sort of 10% area, and we're much lower now, up to 2.6%. So I think that we're probably going to see a little bit more downside in the US 10-year bond yields, which, if that's the case, what does the dollar usually do? Usually follows the US 10-year bond yields, right? So there could be a chance here that we start to see some more pressure on the US dollar, right? So if I actually just take off the inflation rate, can I hide it in any way, shape or form? Can't hide it. I would like to have hidden that, but let's just remove it. Grab compare, just grab the dziecii, which is the US dollar index, whack that on the right hand side there. Again, just index these to regular. This is the price of the US dollar index at the moment, and you can see we get the rising of the 10-year bond yields, rise of the US dollar. We get a fall of the 10-year bond yields, fall after. Remember, so this follows on the US dollar, rise. There you go. So really speaking, if we do see a continuation of this downside in those bond yields because the inflation rate is coming down, we could expect a little bit more downside to come in the US dollar, which kind of, a little bit surprising to me. I expected a little bit of a rebound from the dollar if they held 25 basis points, though, but they didn't. They cut 50 basis points. So the market is expecting more cuts as well. And they're actually expecting, I believe, more cuts than what we were expecting before. If we just go to the CME group, and I show this stuff a lot in terms of what the next meeting is. So this is the 7th of November now, so they're expecting a 25 basis points at the moment. But if you come to the dot plot here, okay, now the dot plot has to be taken with a pinch of salt because it's just basically the opinions of the market and the opinions of the sort of the members of the Federal Reserve, right? So it's not actually anything that is, I'd say, accurate in any way, shape or form, but it just gives us a sense of where people are positioning themselves, right? So you can see the blue line. So if you look at the blue dots, indicate the median projection, and the data is based off the economic projections published. the red dot indicates the effective rate implied by the year end of the Fed fund future price. Okay, so you can see at the moment the red one is where almost the market is pricing in. Okay, so that is the rate implied by the year end Fed fund future price. So that is what essentially what the expectations are. We were at 5.5. We're now at 5%. Okay, that's where we are at the moment. So this is where they're expecting it to be by the end of 2024. So that's essentially another 100 basis points of cuts, even though Fed Chairman Powell has said it's more likely to be another 50 basis points cut. Right, so they're expecting it to be at 4.5%. Market is expecting it to be a little bit lower, and then in 2026 they're expecting it to be around and about 3%, just below that 3% mark. I think it's around 2.8% or something like that. So that's something to consider as well. So what does that tell us? It means that the interest rate is going to come down. Okay, I think obviously it's going to be determined by how quickly it comes down, is the pace of everything else that unfolds after this. Now, I've been talking a lot about sort of recessionary pressures, because typically when the Federal Reserve have done this in the past, it's been followed by a recession. Okay, so let me just remove this for a second. Let's just go up to let's go to the Fed funds rate here, and we will add, what shall we add here? Don't know if I can add anything that's to do with recessions. Obviously we can add the S&P 500 on there, just as a little bit of an outlier. So if I add the Fed funds rate on top of this, I've titled the stream about the Bank of England, and I don't think I've actually talked about the Bank of England yet, but we will talk about it. Typically when we see rate cuts, this only goes back to 2009. That was the emergency cut from COVID, and we had a decline, but it was only quite a small move. You know, that's 35% move. Obviously we then suffered another one, which was 26%. Obviously for some reason it can't go back to 2008. Okay, whatever reasons. Maybe I'll bring up the so this is the federal funds rate. So this is the rate that we know and we see, right? Now the grey areas here are recessions, right? So this is what I've been talking about a lot, is the similarities between this year's price action and 2007. 2007, you can see that we've got this hold of interest rates, this time at sort of 5.25%. We then start to cut in September, and we cut from sort of 5.2% down to 4.25% over a sort of a quick period of time. That was before the end of the year. So that's like again 100 basis points cut, right? And you can see what happened. That is a recession there, where they have to cut aggressively very quickly to try and support the economy. This was in 2000 and 2001, where we had obviously the unfortunate events of September 11th and whatnot. So you've got the rate being at 6.5%, got down to 5.3%, led to a recession. So really speaking, on average, you know, if we look at every time the Fed have cut rates, it's been for emergency reasons, you know, recession. You can see this is where they're cutting rates. Obviously, there have been through periods before where they've done it and nothing's necessarily happened. Again, after a period of hiking, they cut. Recession. This one was like a forced move because the inflation was aggressively higher, so they had to basically force a a recession at that point, with rates being over sort of nearly 20%. But yeah, essentially, the market, every time we've kind of had these little sort of, not every time, but the majority of the time when we've had these sort of cuts, it has preceded a little bit of a recession after the fact. Now, how deep the recession is different questions, right? Obviously, now I'm saying everything's kind of comparing to 2007. Well, is it? If we look at sort of our banks sort of over leveraged in terms of sort of subprime mortgages, I don't think that would be a situation anytime soon. So if we do have a recession, I don't know whether it will be as aggressive as that. But it'll be interesting to see what happens. But I just think that there's a lot of similarities between 2007, not necessarily from what's going on in the world, but necessarily what's happened from a data point of view. So we'll see, because we've got the S&P 500 breaking all-time highs here, and do we hold above this area would be very interesting. Do we hold above these all-time highs? My theory last week was we would break the all-time highs and then close below, which is kind of what we did yesterday, but we haven't followed through with that momentum today. So obviously, if we'd had sort of like a bearish close like this today, I think I would have been thinking that we could come back down towards some lows here. Let me just change this back to regular. Back towards the sort of 5,400 area would be quite interesting to see. So yeah, that was kind of my thoughts at the time, but we are starting to see a lot of risk assets being supported at the moment. One of those being oil, right? So this was actually the, I've put this marker on here. So that was a strategy I was looking at. But last Friday, we had the commitment of trader reports. They were showing us that you should be long oil at the moment. And this is what's happened with price this week. We've started to see a little bit of a climb higher. Started the week around about $68, coming towards the end of the week now around $72. So we have seen a decent little rise in oil prices here. Do I think this is long term? Obviously, we'll have to wait and see. Again, it's all going to come down to different factors like OPEC. What are they doing in terms of supply and demand? I was expecting maybe a move up into this area here, around about $73, just a little bit lower. That was a nice little pause in the market before seeing an aggressive continuation. So I wouldn't mind seeing oil back up towards $73, and then does it start breaking down again, or does it break this and start moving higher at that point for oil prices? But oil prices are going to have a big impact on what happens with inflation. Typically, when you see these kind of lower oil prices, it can be good for countries that import oil, but bad for countries that export oil. So, yeah, we'll have to look at how that could impact those going forward as well. So, the likes of the Japanese yen, this would be a good sort of in line with the play that we were talking about on the Japanese yen with regards to the community trader reports. Oil moving higher would also kind of play into that a little bit. Irfan, trying to stay away from dollar pairs for the time being. Got 30 pips out of GA longs last week and 60 pips out of pound CAD long yesterday. Pound is performing quite good at the moment. Yeah, that's pretty much been down to the situation with the Bank of England just leaving rates unchanged. Against the dollar, we've seen it give back a few of those gains, but like you said, against other currencies, it's done okay. Euro pound is down at the moment, so that's pound stronger than the euro. Pound Aussie is started to fall a little bit more because of the risk sentiment in the market, right? Risk sentiment coming back. So Aussie's performing pretty well. Oz actually had some really good employment data overnight as well. So some strength being felt there. But against the Swiss franc, I quite like it. And against the Japanese yen, I quite like it. This is what we were looking at on Tuesday. Was a little bit of upside into this 192 handle. And this was a bit of a play because we were looking at, so the currency strength meter basically said that we want to be short this market. But when we looked at the technicals, it was like, but do I want to be short here? No, right? Where do I want to be short from? I want to be short up at this area anyway. Obviously, then doing some more research, the commitment of trader report suggested that we should be short in Japanese yen. So pound yen longs made a lot of sense to me this week. I haven't traded anything this week, so I've missed out on a few moves, but I'm okay with that. Just because I was uncertain of where the market was going to go. So to me, I think it's good to just sit on the sidelines sometimes. But this would have been a great area to start looking for that move. This was when Tuesday price action in here. We then started to see a little bit of a breakout, and then on Wednesday we had a retest of that zone before seeing this nice little move higher. So I think if anything, that's where I would have done some business with the market. If I was looking back in hindsight now, it's easy to say that because obviously price has done what I expected it to do. But I wasn't going to necessarily trade this week anyway. But that would have been a nice little move up in here. We did talk about CAD yen, potential CAD yen shorts, but to me, again, look at this market. We're at support. I would have liked to have been down at this 101 area if I was to be a strong buyer of this market. I think if we had got to here, I would have looked to have been a buyer from that point of view, but just didn't get the opportunity to do that. Instead, price came up into this minor level of resistance. Could have took a quick short here. If we would unlock a lower time frame, when price came up into this zone here, we could have been maybe looking at a little bit of a short play here in the very short term anyway. But yeah, again, glad I didn't, because when we looked at the commitment of trader reports, it put me off trying to buy Japanese yen, to be honest. Also looking at the daily chart, where is the real value? It's up here, right? So I don't mind seeing this short-term weakness in yen, because I think that's a good area to get involved, being a buyer again. So I'm happy to just kind of sit on my hands at the moment. But yen was the only kind of obvious market I looked at this week. Dollar Swiss as well. Vincent wants to take a look at dollar Swiss. Yeah, I like where dollar Swiss is positioned at the moment. We took a look at, again, commitment of trader reports. Let's have a little look at those, because the Swiss franc was here showing a short signal, right? On a very short term basis anyway. Why is it showing us a short signal here? Well, it's usually one or two reasons, but mainly because short contracts have reached levels of extremes that we've seen in the past, particularly this area back in January of 2021. Short contracts have reached a similar level. What else I like about this as well, look where we are in the grand scheme of things. If we look at this 1.2 level on the Swiss franc futures, that is a significant high where price has fallen away. So I like the idea of selling Swiss franc right now. I think this is a good market to sell. We also had the balance of trade out of Switzerland today, which was a little bit weaker than what was forecast. So all in all, I quite like that. The only thing I would have liked a bit more is seeing like the 18-month being at an extreme, perhaps even the 36-month. Not too detrimental, that, because of the conditions of the market that we're in, but I would have liked to have seen a bit more of a stronger sell signal here, because if we go take a look at the non-comms positions, what I typically want to see sorry, I feel like I'm blocking the your viewing of the commitment of trader reports here. What I would typically want to see is the non-comms being very aggressively long here, and they're not, right? So non-commercials, so these are traders in the market, right? These are the ones that we typically want to follow from a week-to-week basis. They're not aggressively long. Now, why do I care about that? Well, basically, when they get aggressively long, right, in line with commercials getting aggressively short, it can create these type of moves, right, where we get this nice little sort of rebound continuation to the downside. Quite clear of what we can do there. Okay, now I'm not saying that is the only reason that we need, but it just makes for a stronger signal when you've got both doing the opposite sort of thing. Back here, for instance, right, where you got this January 21, short contracts are at a very strong level. We've got commercials being aggressively long, and basically what they're doing is they're taking those positions off, right? Now, depending on how they then view the market will depend on whether we see this as being a long-term move or whether it's a short-term sort of rebound in the market. I feel like this one this time could be a bit of a short-term rebound before maybe seeing a continuation, so maybe back into the 115s there on that weekly chart. So I like the Swiss franc. I like it a lot. I want to sell it. Where do I sell it against is what we need to try and focus on next. And I'm just trying to wait for the market to settle a little bit, right? That's why I like pound Swiss. Pound Swiss could be quite a good one because Bank of England haven't cut rates. Growth has been okay. GDP was kind of the same for the past couple of months. But if we look at this weekly chart, you know, had sort of 3 weeks of price just kind of stalling, and now it looks like we're starting to break higher again. You know, that to me is a sign that we could see some further upside. You know, look at this area where we saw a significant sell-off in the past. Could we come and target that 115? So I quite like this market a lot. What I would need from this market, though, is a little bit more, right? So you could argue that there's like a flag pattern here. Price has now breached that and we're moving higher. I'd like to see it close above. You know, can we close above these highs here? Can the market hold above? Can we come back maybe back into this kind of area where support has been held, and then continue to push higher? That's what I'd like to look for pound yen. We've also got this kind of minor resistance zone as well over here, so you could be looking at something like that as your short-term move. CAD Swiss was also on my radar a while ago, but because of the situation with CAD at the moment, not seeing anything there. Nice little rally. Price has come back into the demand zone here from a daily chart perspective. You know, I need to see price kind of breaking some key levels now in order for me to be super interested. You know, at the moment we're still kind of hanging around this resistance trend line. You know, if price pulls back into here, it may go, but really speaking, I need it to take out some highs here before I get really interested in that. But yeah, I think Swiss is a good market to have a little look for. This was the seasonal short play that we talked about before. We talked about getting short on a seasonal play here, which worked out really nicely. Now look at this market. Look at Euro Swiss. Again, like a little head and shoulders pattern there. So maybe if that breaks, that could be a nice move back to the upside as well. So Swiss is setting up really nicely, I think. I think that's where I'm going to focus a lot of attention. Swiss yen. Let's have a little look at Swiss yen. I know Swiss yen has moved quite a bit. Kind of back into this level now, aren't we? These kind of lows that it's taken out. Or you could argue this demand zone. Let's have a look at the daily chart. I'd have put the demand zone a bit lower, I think. Sort of down here. So maybe not quite what I was expecting there. Yeah, I might leave Swiss yen alone. Kiwi Swiss was on my radar while sitting at 0.52 flat. Unfortunately, didn't get there. Let's have a look. Yeah, I like this. I like this. Support has been held here. Price starting to push through. Back into that sort of resistance zone at the moment. Trendline resistance as well. Yeah, that's... that needs some work. That one needs some work. Aussie Swiss. What's Aussie Swiss doing? I think the ones I like the most, I think CAD Swiss has got a lot of potential because it's quite low on the chart. So I'm looking at the kind of value. Euro Swiss I quite like because it's got that inverse head and shoulders in this demand zone, and also pound Swiss are quite like. I'd say out of the Swissy pairs at the moment, those are the ones that are standing out to me the most. But yeah, I think the Swiss franc looks really good at the moment. If anything, like I said, that is probably where my focus is going to be for a while, you know, especially if we come and have a look. I always try and see where those commitment to trader reports are really showing up. I mean, look at this as well. Maybe we should have looked at the VIX futures in terms of where we could have seen volatility go next, because there was a short signal on the VIX last week on the futures market. Why? Well, we can see that the sell-off from the non-coms have been quite good. Longs have been quite aggressive. Short contracts have dropped. Long signals have been fairly effective on this. Let's have a little look at this. Let's go to... what is that? I mean, this would have been a beauty if you were looking for volatility to come back into play. Sorry, I'm just kind of looking at the... I've just realized I was doing that without talking then. So this is the VIX futures. When you're looking at VIX futures, you don't necessarily want to look at the comms, because they're not really trading volatility, right? So you want to be looking at what the traders are doing, the non-com index. And what I'm looking at is how the market responds to being at extremes over an 18-month period. I might be able to drop that down to 6 months. Let's just see. No, that's the wrong one. And see if that gives us anything. So basically, again, when non-commercials get aggressively short something, you want to be looking to do the opposite, because they're looking to take profits, right? And if we compare that with how price moved, we saw a significant shoot up in the VIX. Here was another sort of extreme low point, and the VIX started to rise slightly here. That was from the end of 2023, right? Then obviously they've come down again. So what happened here? They were getting aggressively long. Price moved lower. Now they're getting aggressively long again on a 6 month. So what does that tell me? Well, that tells me that we could start to see the volatility index drop off a little bit, which would go in and kind of hand in hand into risk on in the equity markets. Again, look, aggressively long. What happened? Price fell away. Aggressively long. What happened? We did get a short-term spike, but a bit more downside. Aggressively long, move lower. Aggressively short, didn't really rally though, just kind of went sideways. Aggressively long, sold off a little bit. Aggressively short, rallied. So this is why I like following these types of tools, because you can see how well the market can react to them. And we can see obviously the VIX up here showing sort of a short signal at the moment. So maybe this equity run that we're seeing in the markets at the moment, which I don't know whether to believe or not, if it does sustain above these highs, I think we've probably got to flip our mindset that this is going to go higher, and that it could go higher. So that's why I was kind of looking at pivot points and stuff. I was just trying to figure out, could the market go and target some mathematical levels? So these are the weekly pivot points. So I'm kind of looking at sort of where the this week's resistance 2 is, this week's resistance 3. I'll see if that paints into next week, see where those kind of land. But that's something you can look at. Let me just turn that to 1. There you go. That's what I'm kind of looking at. You see the market's actually holding there at the moment. So it'd be interesting to see if we break back lower here. If we get back below the 56.72s, right, I think that's going to be bearish for price. But with the analysis we've just done, you know, and the VIX futures showing us that potential short signal, then usually if the VIX falls, we get an upside in equities. So the risk on rally might be something that's a little bit more on there. Let's have a little look at what else is being shown up here. Obviously the dollar a little bit as well, showing a little bit of a potential short signal there. Crude oil was the one we were looking at really this week. If we look at the commercials here, you can see that longs are reaching significant levels. Shorts are fairly low. Let's have a look at what's going on. Again, you'd want the shorts to be doing the opposite from the non-commercials. You want to be seeing them being aggressively short. They're at similar levels. I would like it to be much higher. Don't get me wrong. I would like this to be much higher for a significant move, like for a significant turn. But it might just be a good turn in the short term. Perhaps back into that sort of $75 area on those. Gas, natural gas, gold. Yeah, gold's not nowhere near ready yet. Cotton. I don't know how cotton's performed recently. Pulled back a little bit, I think, this week. But cotton was having a good one. Bitcoin as well. Now, this could tell us about the risk sentiment in the market. Not a lot of data here when it comes to, obviously, again, you don't really want to be looking at the com positions on this. You want to be looking at the non-coms. But I mean, look at that. They basically do the exact same thing. I mean, I guess the only thing that I can take away from this right now is that for the amount of time we've had it, we had an extreme here, which then saw a downfall, and we had an extreme here, which then saw the market go sideways. So if we get up here again, that might be the turning point for some downside. There's been a lot of lows in this though. Yeah, I don't like looking at that. And obviously Japanese yen, Mexican peso as well is looking pretty good. But Japanese yen, I'd like to see how this has changed this week. If it has not, or if it has or not. You know, I like where the yen is positioned. Short-term rebound maybe. Back down towards that level we like before seeing either a continuation or a rollover. We'll have to wait and see. But short contracts are the highest they've ever been. From a commercial side, I was just wanting to see where are the long positions from the non-coms. They're at similar levels to here and here, which is there and there. Let's have a quick look at what happened in 2007. Because obviously a lot of price action's been sort of reflected. So short contracts in 2007 were at 214,000. Where are we now? We're at 290,000. That was 100. Let's see if I can squeeze all that in then. Let's go to 2,000 there. 2007 was here. What I'm looking at is the price action that was here. It's very similar to the price action that was here. Okay, you know, we had that sort of downward move, or that sort of downward move, right? Had a pump up back into weekly highs, had a pump up back into weekly highs. So what we need to try and figure out is this going to be a short-term consolidation before a lot of yen strength, or is this going to be a rollover of yen weakness? Now, again, if you think of the dollar yen, you need to flip it over, which could be the case, really, which could be the case. Because you've got the Bank of Japan potentially going to hike interest rates. We've now got the US market in an easing cycle, right? Let's just do a chart. Let's just have a little look. And we'll go dollar yen. Sorry, I feel like this stream today, guys, I'm just more in looking at thoughts and things like that. Hopefully you're following along. Hopefully you find it interesting. I'm just kind of looking at sort of ideas at the moment. So this was 2008, 2007 over here. This is the area we're kind of talking about, right? Or was it? Where's 07? This is 07. I guess it's this area, actually. Where's that? On there. Let me have a quick flip back. Yen futures. You have to inverse the chart, so it'd be the highs. Inverse the chart, so it'd be the highs. Here you go, it's here, right? So what we're talking about is what happened here and what happened here, right? Are we going to see a similar path on dollar yen that we saw here? You know, that could bring prices back down towards these kind of 115 areas, right? You know, 126s, 115s. That's quite a significant move down. That was a 34% move. If we had a similar, I'm going to try and go from higher up, actually, where I think the market is going to go. Now, 34% kind of brings us down into these kind of lows here. I mean, that would be a horrendous carry trade if you want to hold that. But obviously, we can see it has happened in the past. This is the area we're kind of looking at. Let's just now add Fed funds rate. I just want to see if there's any correlation at all. There might be something, there might be nothing. So let's just compare it. New right scale. So this is where the Fed cut in the past, right? So I need to go to there. That was the sort of first cut in September, October. And this one's lagging behind, so we know that it's been cut now. But we cut this week. And look what happened. The market fell, but then also kind of rebounded for a little bit there in that sort of period. And then conditions fell off as well. So there's a lot of similarities that I'm seeing at the moment. So we're seeing a similarity in the cycle, which is the Fed funds rate cycle. We're seeing a similarity in the commitment of trader reports from Japanese yen. There was also some similarities with the S&P 500 in 07 as well. So a lot to think about. A lot to think about going forward. But yeah, right. We've been going for about an hour, guys. I'm probably going to leave it there. Some food for thought going into next week. Obviously, we've got the Bank of Japan interest rate decision as well. When does that come up? I think that's overnight for me. Let's have a quick look. Yeah, BOJ policy rate decision coming up overnight. So I would not be in anything Japanese yen at this point. But definitely some food for thought. All right. I'm going to leave it there, guys. Thank you for watching. I will catch you. I won't be on next week, actually. I'm on holiday again, so I won't be on streaming next week. I'll be on the week after. So thanks for watching, guys. I'll catch you soon. Cheers.